Welcome. Today we're doing a complete deep dive breakdown of LIC's Q4 FY26 financials. And let me tell you, we're not just going to sit here and read off the numbers, we're going to decode the actual strategy behind them. LIC has completely blown past market expectations when it comes to profit, margin, and overall business growth. So let's jump straight into the data and see what's really going on under the hood.
Right off the bat, let's address the elephant in the room. The absolute biggest question on every investor's mind right now is this: will the LIC share actually hit $1,100? Brokerage house MK has maintained its buy rating and assigned that exact target price. But, we have to ask ourselves, does one really strong quarter automatically make it a rock-solid long-term investment? Well, let's find out together.
Before we get too deep in the weeds, here's our quick roadmap for this explainer. First, we'll hit the Q4 result highlights. Then, we'll break down the VNB margin. After that, we're comparing par versus non-par products, looking at some key market risk factors, and wrapping up with the future outlook. Simple as that.
All right, let's kick things off with Section 1, the Q4 FY26 result highlights. We're going to do a really quick, punchy summary of where things stand right now. The standout figure here is just massive. We're talking 229.5 billion rupees. That is LIC's annual premium equivalent, or APE for short, representing a really solid 22% growth over last year. And what's absolutely crucial to note here is that this figure didn't just meet expectations, it comfortably beat all market estimates. It's a seriously strong start.
Now this illustrates what is arguably LIC's biggest victory this quarter. Take a look at that jump. The VNB margin surged to 25.7% in Q4 FY26. To put that into perspective, it was sitting at just 18.7% in the exact same quarter last year. This massive leap essentially means LIC is writing significantly more profitable business than they were before.
Tying right into that, the value of new business, or VNB, has literally skyrocketed by 67%, reaching a whopping 58.9 billion rupees. In the insurance sector, this isn't just some vanity metric. It's a vital indicator that directly points to future profitability. But it's not just the new business looking good. Their net profit grew by nearly 23% as well. Alongside those numbers, they announced a 10 rupee per share final dividend. Generally speaking, a dividend like that is traditionally viewed by the market as a very positive, confident signal for investors. Moving on to Section 2. We just threw around the term VNB margin quite a bit, so let's actually break down what that means and figure out what exactly is driving that future profitability.
So what exactly is VNB margin? Let's skip the textbook definition. In the simplest terms possible, it basically tells us how much profit the company actually keeps in its pocket out of every 100 rupees of new premium it collects. It's a direct indicator of future profits from brand new policies. When you see a growing margin, like we just did, it naturally means the company is bringing in better quality business and creating far more value down the line.
You're probably wondering, why did this margin improve so dramatically for LIC? Well, the earnings report points to three specific reasons. First, a massive growth in their non-par products. Second, a very deliberate focus on high-ticket policies. And third, an improved overall product mix. When you combine those three factors, they are the main driving force behind this record profitability.
Which brings us right into Section 3, par versus non-par products. Let's understand the strategic shift that management made to get these numbers. Think of it like a balancing act. On one side, we have par products. This is where the company shares profits with its policyholders and offers guaranteed returns. It's great for the customer, but it means lower margins for the business. On the flip side, we have non-par products, which allow the company to keep much higher margins for itself. The crucial takeaway here is that LIC's management intentionally shifted their focus heavily toward these high-margin non-par products. That strategic pivot, that's the secret sauce behind this massive profit bump.
Now, let's transition to Section 4, key market risk factors. Because as exciting as those numbers are, any objective financial explainer has to take a step back and weigh the potential downsides.
There are three main risks that could legitimately threaten LIC's future income. First up is persistency. This is simply the risk that policyholders decide to drop or cancel their policies halfway through, which obviously takes a direct hit on expected future income. Second is market volatility. LIC has massive exposure to the equity markets, so a significant market crash would severely pressure their embedded value. And third, we have regulatory changes. Specifically, there's an upcoming risk-based solvency framework that could suddenly increase the amount of capital they are legally required to hold. If you're an investor, keeping a close eye on these three risks is absolutely essential.
Finally, let's move into Section 5, Future Outlook and Target. What is the strategy actually looking like for FY27 and FY28?
LIC's management has laid out a very precise 4-point focus for the future. They are targeting absolute VNB growth, delivering consistently better margins, aggressively pushing higher ticket size policies, and improving persistency, which basically means keeping their existing policyholders around longer. If management can actually execute on this 4-point plan, their earnings growth could remain incredibly robust going forward.
Now, based on this positive execution, brokerage house MK is maintaining a buy rating, and they've set a target price of 1,100 rupees. Looking at this purely objectively, long-term investors often view LIC's immense trust, its legacy brand, and its unparalleled distribution network as the foundation of an undervalued giant. And now it looks like a giant that is finally figuring out how to improve its margins.
So, to quickly sum it all up, LIC has shown exceptional VNB growth, massive margin improvement, and they declared a solid dividend. But, as we covered, those key risk factors are always lingering in the background. So the big question remains, is this a long-term giant finally waking up, or are we just looking at short-term volatility? Do you think LIC can maintain these high margins in the coming years? What's your take? Let us know your opinion in the comments below, and don't forget to subscribe for more clear slide-based explainers just like this one. Thanks so much for joining us.